You clicked on this video because you are staring at your 401k enrollment form and you do not know which box to check. You are terrified that picking the wrong option will cost you hundreds of thousands of dollars in your retirement. The real problem is that most people default to the traditional option simply because it is the employer standard. But that choice ignores a massive mathematical advantage available to young professionals right now. By the end of this explanation, you will understand the specific strategy called tax bracket arbitrage and why paying taxes today is almost always the superior move for building long-term wealth. Let us start by defining the two paths you are choosing between. A traditional 401k allows you to contribute money before taxes are taken out, which lowers your taxable income for the current year. You do not pay any taxes on that money or the growth until you withdraw it in retirement. A Roth 401k works differently. You contribute money that has already been taxed at your current rate, but every dollar of growth and every dollar of withdrawal in retirement is completely tax-free. The standard advice suggests that deferring taxes is better because you get to invest the full amount now and pay the taxes later when you supposedly have less income. This logic feels sound, but it relies on a critical assumption that is often wrong for people in their 20s and 30s. The core of the argument for the Roth account lies in the concept of tax bracket arbitrage. This is not about avoiding taxes entirely. It is about recognizing that the timing of when you pay those taxes changes the final outcome due to the power of compounding. When you choose the traditional route, you are essentially borrowing the tax money from the government. You get to invest that tax amount for decades, but you must pay it back with interest in the form of higher taxes later. When you choose the Roth route, you pay the tax up front, and the government gets no interest on that money. The question is whether the tax rate you pay today is lower than the rate you will pay in the future. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. Consider the math behind this decision. If you are a young professional, you are likely in a lower tax bracket now than you will be at the peak of your career. But the real arbitrage opportunity exists when your current tax rate is lower than your expected withdrawal rate. Let us look at a concrete example using data from the Smart 401k calculator. In a scenario where a contributor faces a 25% current tax rate versus a projected 20% withdrawal rate, the Roth account accumulates $153,395 over 40 years. The traditional account in the exact same scenario only accumulates $134,866. That is a difference of nearly $19,000 simply by paying the tax bill sooner. This result happens because the tax-free compounding on the Roth account eventually outweighs the immediate deduction of the traditional account. The key variable here is the ratio of your current tax rate to your future tax rate. For a 24% bracket today, you would need your future income to be taxed above approximately 31.5% to make the traditional 401k superior. Most young engineers and professionals rarely hit that threshold because their career progression caps out before retirement, and historical data suggests that marginal tax rates for top earners have been remarkably stable or even declining in real terms. The fear that you will be in a much higher bracket in retirement is often a false positive that leads to suboptimal decisions. Now consider the opportunity cost of the traditional strategy. Unlike software architecture where you can refactor your code later, the tax treatment of 401k contributions is a hard commit at the time of funding. When you defer taxes, you are leaving money on the table that could have been compounding tax-free. For a 30-year horizon with a 7% return on a $20,000 contribution, the opportunity cost of paying taxes now is the lost compounding on that tax amount. The benefit of deferral is erased unless the future tax rate differential is massive. Since the probability of a young professional's income dropping to a significantly lower bracket in retirement is statistically low, the certainty of your current high marginal rate becomes the critical leverage point. There is a nuance here that many people miss. This strategy requires that you have the cash flow to pay the taxes now. If paying the taxes up front forces you to reduce your total contribution volume, the arbitrage fails. You must be able to contribute the maximum amount to both accounts to truly maximize the benefit. If you have to cut your contribution to afford the Roth tax bill, you are losing the compounding on the principal, which is the engine of wealth creation. However, for most young professionals with stable income, the ability to pay the upfront tax is not a barrier. For high earners, the debate changes slightly. Strategies like the backdoor Roth or the mega backdoor Roth allow contributions to a Roth-like structure regardless of current income. This effectively eliminates the tax bracket arbitrage debate for those individuals because they can move money into a Roth account regardless of their bracket. For standard earners, however, the low-rate entry point is the critical leverage point. The choice between traditional and Roth 401k is less about current bracket optimization for high earners and more about liquidity and estate planning. But for the majority of you starting your careers, the low-rate entry point is where you should focus your energy. The uncertainty of future tax policy is often overestimated by professionals. While tools like OWL utilize complex optimization algorithms to model Roth conversions, they cannot guarantee future rates. Yet, the data favors the Roth for long-term growth under the assumption that future tax brackets will rise or remain stable. The gap in user education is significant because standard industry calculators often default to traditional 401k logic. This suggests that the default setting is not the optimal setting for your specific financial situation. You must actively choose the Roth to capture this advantage. Here is the final insight that ties everything together. The effective tax rate on the principal grows at the same rate as the account balance in both models. This means that the lower current tax rate is the only variable that compounds. If you pay a lower tax rate now, that lower rate applies to a larger balance in the future. If you defer the tax, you are paying a higher rate on a smaller balance. The math is clear. Paying taxes now at a low rate is mathematically superior to deferring taxes to an uncertain, likely higher future rate. This is not just a theory. It is a proven strategy backed by empirical evidence and simple arithmetic. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.